Let's see question 182. Requirement is, what is the adverse sales price variance? So it is categorically mentioned that variance is going to be adverse. They are asking us to calculate the amount of that. Logically, when your actual selling price is lower than standard selling price, means standard selling price is higher, but actually we have sold at a lower price. So obviously, if we have sold at a lower price as compared to the standard selling price, then your sale price variance will be adverse. How do we actually calculate sales price variance? If you recall the formula, sale price variance is equal to actual quantity. Means actual quantity sold into actual selling price minus standard selling price. We know that when it will be adverse, if your actual selling price is lower than standard selling price, then sale price variance will be adverse. Let's see. Bloom was the subject of the following press story. Bloom is proud to announce that it has managed to maintain its market share despite an overall increase in the market size by 10%. Okay. However, the sales directors, when challenged by this journalist, recently admitted having been forced to reduce price by 1.5. So basically, they have maintained the market share, everything, but they had to reduce the price by 1.5. Of course, when your selling price is lower than standard selling price, then your sale price variance will be adverse. Per bunch on average on a budget volume is 12,000 bunches. All is not as rosy as it seems in Bloom Garden. If the standard variable cost of Bloom bunch of flower is $20, variable cost. Variable cost is $20 and a standard contribution gain is $5. Now examiner is asking us what is the adverse sale price variance. We have already made a mind that if actual selling price is lower than the standard selling price, so definitely the variance is going to be adverse. First of all, standard selling price, variable cost, examiner has given us $20. Examiner has given us the contribution 5. Of course, selling price minus variable cost gives us contribution. Selling price minus variable cost gives us contribution, which means that variable cost plus contribution will give us selling price. Logically, your standard selling price is 25. Simply, selling price is equal to variable cost plus contribution. So, standard selling price is 25. Actual selling price is 1.5 lower than the standard selling price. It is written in the question because it is mentioned that they had to reduce the price by 1.5, which means that actual selling price is 25 minus 1.5 will give us 23.5. It means sales price variance is equal to your actual selling price is 23.5, standard selling price is 25. Now come here. Bloom is proud to announce that it has managed to maintain its market share despite an overall increase in the market size by 10%. Now try to understand. Market size has increased by 10%, but still Bloom has managed to maintain its market share. Assuming, I'm just assuming, okay? Assuming that market size is 1 lakh, okay? I'm just assuming that market size is 1 lakh and my share is 12,000 bunches, 12,000 units. I'll be selling 12,000 units out of that 1 lakh. It means if you calculate the percentage, it comes 12%. I'm just assuming that market size is 1 lakh and my budget says that I will be able to sell it 12,000 units. Logically, 12% of the market I will have. Now, let's assume that market size increases by 10%. If it is increases by 10%, so 1 lakh into 1.1, it becomes 1 lakh 10,000. So we can see that market size has increased by 110. Question says even though the market size has increased, but we have still maintained the market share. If we have still maintained the market share, it means earlier we budgeted that we will be selling, let's say 12,000 units. Then it means actually we sold how many? 13,200 units. If you take 13,200 divided by 1 lakh 10,000, it will give you a 12%. Read the question again. The question says, despite increase in the market size, we were able to maintain the market share. It means market size has increased by 10%. Then whatever we have initially budgeted, thought that sale quantity, actually it has also increased by 10%. So instead, this is on average budget volume is 12,000 bunches. This is your budget volume. And the question says market size has increased by 10% and we were still able to maintain the market share. It means your actual sale was also increased by 10%. So logically your actual sale quantity is 13,200. So I think few points are very important, especially actual quantity. So I am getting 19,800 adverse. I'm getting 19,800 adverse. Okay, what is the favorable sales volume variance? It itself says the question. Favorable sales volume variance. Now listen. When your actual quantity sold is more than budgeted quantity sold. If we have actually sold units more than what we budgeted, then your sales volume variance will be favorable. Repeat. When your actual quantity sold is more than the budgeted quantity, then obviously your sales volume variance will be favorable. Let's see. In this question, budgeted volume is 12,000. Actual, we know that 13,200. So sales volume contribution variance. Because in the question we have contribution, we don't have profit. So we'll be using contribution. Standard contribution per unit. If your actual quantity sold is more than the budgeted quantity, then your sales volume variance will be favorable. Actual quantity sold is 13,200 and the budgeted volume is 12,000. Let me use a calculator. I'm getting 6,000 favorable. Why we are having sales volume variance favorable? There's only one reason. What is the reason, students? Can I say the reason is your actual sales quantity is more than the budgeted sales quantity. That is why your sales volume contribution variance is favorable. Why we are not saying it is sales volume profit variance? Because we don't have profit in the question at all. So that is why we're saying it is sales volume contribution variance, which is 6,000 favorable. Okay, question 184. Student, if you recall in the previous class, we have already discussed all other variances. What is the value of adverse sales mix variance? First of all, sale mix variance can only arise in an environment where organization deals in more than one products. And when of course your actual sale mix is different than the standard sale mix, then sale mix variance will arise. So students, I'm giving you around, I would say 3 to 4 minutes. Try to attempt this question, then we'll be doing it together, inshallah. One student so far has replied. Let's see what other students say. What is the value of adverse sale mix variance? Yellow sells two types of squash balls, type A and type B. The standard contribution from these balls is $4, $5 respectively. And a standard profit per ball is 1.5 and 2.4. Now listen student, if company follows absorption costing, then we'll be using profit per unit. If company follows marginal costing, then we'll be using contribution. So it simply depends which costing company follows. Respectively, the budget was to sell 5 type A balls for every 3 type B balls. So examiner is giving us the standard mix says the ratio should be 5:3. Actual sales were 2,40,000 balls, which is 20,000 balls higher than the budgeted. So actual sale is 240. The actual sale include 200,000 type A balls. So total actual sales are 2,40,000. Out of this 2,40,000, if 200,000 belongs to type A, so obviously 40,000 belongs to type B. Yellow values its stock of balls at standard marginal cost. So we'll be using contribution, standard contribution. So question 184. Product we have got, let's say A and B. We'll take actual quantity into actual mix. Straightforward, they've given us type A 2 lakhs, so obviously B is 40,000. 2 lakh 40. Now actual quantity into standard mix. Obviously the total remains same. So product A total is 240 and the ratio they have given us, I think it was 5:3. 5:3. So 5 upon 8, calculator. 2,40,000. 2,40,000 multiplied by 5 upon 8. I'm getting 1,50,000. So 2,40,000. 3 upon 8, obviously 90,000. 150. Here I got 90. Okay. Simply sales mix variance in units. Students, if you recall that sale mix variance in units, total has to be 0. Is that clear? Why total will be 0? Can I say logically sale mix variance in unit is a difference of two columns in which total is same? Only the difference is in the ratios. Total is same, but difference is only in the ratios. Is that clear, student? Yes or no? Okay, look at this. Actual sales, actual mix is 2 lakh. It is 150. So you have actually sold more. How many? Logically favorable. Here actually we have sold less. We have mixed less. So adverse. Standard contribution per unit. The standard contribution is type A is 4, B is 5. Now sales mix variance in dollars. 4 into 50 will give us 200,000 favorable, but 2 lakh 50 adverse. So logically, the final answer is 50,000 adverse. So final answer is 50,000 adverse. I strongly believe this should not disturb us at all. Let's see any option. No. 50,000. Adverse, they have already told us. Okay, question 185. What is the favorable sales quantity variance? Students, please try to attempt, then we'll be doing it together as well. But I really want you to try. You should be able to solve this now. So students, any answer? It is already mentioned favorable. If it is favorable, then it is understood that your actual sale is more than the budgeted sales. Sales quantity variance favorable means, okay, we're getting answer. One student says 87,500. Let's see. Favorable sales quantity variance means, of course, your actual sales units are more than the budgeted sales units, and it is mentioned in the question as well. Actual sale is 2 lakh 40, which is 20,000 higher than budgeted. It means your budget was 220. Question 185. Actual sale is 240 units. Budgeted sale is 220. So organization has managed to sold how many units more? 20. All we need is just multiply this 20,000 with the average, I would say weighted average standard contribution per unit. Weighted average standard contribution per unit. Just a minute. Okay. Product A, type A is having contribution $4 and the ratio is 5 out of 8. Another product is having contribution 5 and the ratio is 3. Contribution is 4. And how many units? Should be 5. Then contribution is 5 and the units are 3. Total number of units, they're 8. Calculate. 4 multiplied by 5 plus 5, 35 divided by 8. I'm getting weighted average contribution 4.375 per unit. So that's perfect. Whoever has calculated 87,500 is just perfect. 87,500 is just perfect. Let's see. 87,500. Question 186. Which one of the following best gives the favorable sales mix variance in July? Student, sale mix variance, again, sale mix variance is the difference between actual quantity into actual mix and then actual quantity into sale mix. Okay, so I really want every one of you to attempt this quickly. I think this should be done within 2 to 3 minutes. Let's see who will reply now. Which one of the following best gives the favorable sale mix variance? You can see that they have given us the actual sale units. Actual sales units, they will work as actual quantity into actual mix. Examiner has given us budgeted units as well. So by using these budgeted units, it gives us the ratio. You can say the ratio is 3:6. Okay, any answer from the student? So far, no answer. Okay. Let's read the question then. John's monthly absorption costing variance analysis report. Can I say if they're using absorption costing, then we need standard profit per unit? Includes a sale mix variance which indicates the effect on profit of actual sale mix differing from budgeted sale mix. The following data are available. Okay, one student is saying 2667 favorable. And another is also saying, I believe, standard profit per unit. They have given us product X is having standard profit 4 and Y is having 6. Let's see. Question 186. We've got product X and Y. Actual quantity into actual mix. They have given us 2 and 8. Now we will convert this actual quantity into actual mix. We'll convert this according to the standard mix. So actual quantity into standard mix. Of course, the total will remain same, but the ratio will change. The ratio was, I think, 3:6, if I'm not wrong. Which means that 10,000, 3/9. Here's the ratio 3,000, 6,000. So you can say that 3:9. 3:6 means the ratio is 3:6, so 3/9. Let's see how much we are getting. 10,000, 3/9. 333. So obviously here I'll get 6,667. Okay, fine. Now let's go for the difference. Sales mix variance in units. Logically, the first one is adverse. Your actual units, they are less than what the standard says, and they are minus 1333 adverse logically. And the y, it is favorable, exactly 133 favorable. Total has to be 0, we know that. Now we'll be using standard profit per unit because of absorption costing. Standard profit per unit. 4 and 6. They have given us the standard profit per unit. 4 and 6. Oh, 4 and 6. What happened? So here comes your sales mix variance in dollars. 5332 logically adverse. 7998 favorable. Students, overall we are getting 2666 favorable. Okay, let's see the option. Can I say the last one? Of course, we got the answer 2666. Here it is 67. It's the same thing. No issue at all. What is the sales quantity variance? Now, student, I'm giving you around 4 to 5 minutes. Please try to attempt this. You should be able to do it. Let's see who will answer this question. Student, if you just recall, so we actually, first you need actual quantity, but according to the standard mix. Then, of course, budgeted quantity into standard mix. Let's see any answer. One student saying 158 words. What about others? Actually, budgeted sales into standard mix, they have given us a straightforward here. 1000 to 3. And the ratio is 1 is to 2, 2 is to 3. Just a minute. Question 187. Sales quantity. Question 187. Product, we have got XYZ. Budgeted quantity into standard mix. 1000, 2000 and 3. Then we'll take actual quantity into standard mix. Actual quantity is here 1100, 2050, 2800. If I add all of them, just a minute. 1100 plus 2050 plus 2800. I'm getting 5950. Now this 5950 should be mixed according to the ratio of 1 is to 2 is to 3. So which means that 5950 should be equal to 1000 upon 6000, or you can say 1 upon 6. It's the same thing. Okay. So 5950 1 upon 6, we're getting 99 1 point, let's take it 66667, okay. Then Y is exactly the double of this. You can see that it is exactly the double of this. 5950 2 by 6. 5950 2 by 6. I'm getting 1983.33. Then of course Z you can take as a balancing figure, no issue at all. 991.67. 19833. So 991.6983.33. Z I'm getting 2975. Now let's see quantity variance in units. Sales quantity variance in units. Look at this. Either in case of sales quantity variance in units, either they will all be adverse or they will all be favorable, because it is the difference between logically budgeted quantity into standard mix and actual quantity into standard mix. The ratio in both the columns, the ratio is same. The difference is in the volume. So if your actual quantity is less than budgeted, so all the variance individually will be adverse. If your actual volume is more than the budgeted, then your each variance will be favorable. So simply 1000 minus 991.67 gives us 8.33 adverse. Here we're getting 16.67 adverse. Then simply 25 adverse. Okay, we have got selling price. Profit per unit, examiner has given us 2, 5 and 2. Standard profit, standard profit. Standard profit per unit was 2, 5 and 2. So sales quantity variance in dollars. 8.33 into 2. I'm getting 16.66. 16.67 into 5, 83.35. And this is 50. So final answer, I'm getting 150.01 adverse. Make it 150. Let's see. Student answer is A. Question 187. And we are getting answer A. Obviously, if you know the format, so this will not disturb you. But if you don't know the format, then it will only disturb you. Okay. Now, student, I'm giving you again around 2 minutes to attempt question 188. But kindly attempt this one. It looks easy. I don't know. First solve it. Try this, then we'll be. Let's see who is going to answer. Wait and see. Okay. Students are replying. One student is saying C. Let's see. The publication of material, okay, which of the following statements are true regarding material price planning variances? The publication of material price planning variances should always lead to automatic updates of standard cost. If you recall, planning variances, they arise due to, I would say, uncontrollable events. There is no doubt about it. But the question says the publication of material price planning variances should always lead to automatic updates of standard cost. Basically, when you are saying should always, so don't say should always lead to automatic updates of the standard cost. Why? Because when you are challenging your original standard cost, then that, for example, it has become, let's say, obsolete, you give us reasons. Without giving us a reason, it becomes difficult that always we will be updating the original standards. So when you are saying whenever there will be material price planning variances should always lead to automatic updates of the standard cost, the answer is no. We need reasons. Simply you need some sort of justification that your original standards are now obsolete. Without that reasoning, we are not going, it will not always happen. That is why we are saying false. The causes of material price planning variances do not need to be investigated by managers at any level of in the organization. Why we are saying false? Because the question says the causes of material price planning variances. We know that planning variances are not controllable, do not need to be investigated by the managers. Actually, at any level in the organization, at least don't say this that it is, there's no need, it will not be investigated in the entire organization at any level, because even though the planning variances they are arising, we need to know the reasons. Why do we need to actually revise our original standards? So we do investigate the planning variances so that we can learn at least why these planning variances are arising. So both the statements are false. So perfect. So it is simply perfect. Neither one, no two. Okay. Student, please now attempt question 189. You have got around 3 minutes. Kindly utilize this time properly. What is the level of actual sales? Okay. Leaf Limited has had a mix here. Its market share has improved 2% to 20. Its market share has improved 2%. So basically your market shares improved by logically 2%. Now it is 20%. If your market share has increased, let's say, by 2% and now it is 20, it means previously your market share was 18%. Read it again. Its market share has improved 2%. Market share has improved 2%. So whatever initially your market share was, it has increased by 2%. Now it is 20. So it means previously it was 18%. Okay. But the overall market had contracted. So market itself has actually reduced by 5% in the same period. Market size has shrunk by actually 5%. Okay. The budgeted sales were 5,04,000. Standard contribution was 12 per unit. So what we need to do? They're asking us what is the level of actual sales. 2 percentage points up on the budget, 3 percentage down, 3 percentage up by 5.5 to 5,32. Let's read it again. This is your budgeted sales were. Of course, budgeted sale were 50. 4. First of all, you need to understand one thing. When we made a budget and we had a budgeted sale 5,04,000, at that time, market share was 18%. First of all, logically 5,04,000 units, they represents market share 18%. This is market share. If market share 18% represents 5,04,000 units, so what is the market size originally? 5,04,000 units, they represents 18% of the market share. So all you need is just gross up this 504, bring that 5,04,000 units at 100%, 100 upon 18. Logically, 5,04,000 units, they represent 18%. Of course, market size is 100%. So 5,04,000 multiplied by 100 upon 18. So I'm getting 2.8 million. So basically, the market size is 2.8 million. Okay, now we need to find out actual sales units. Before we find out actual sales units, the question says the market size has reduced by 5%. If the market size has reduced by 5%, then I will take 95% of that. So 95% of 2.8 million is actually 2.66 million. So now the market size is 2,660,000. And now our market share is 20%. We have a market share 20%. Now the market size, entire market has reduced by 5%. So now the new market size is 2,660,000 and we have got 20% share. So 20% multiplied by 2,660,000 will give us 5,32,000 units. So logically, actual sales units are 5,32,000. Actual sales units are 5,32,000 up by, so we can calculate this also. 5,32,000. Previously, we had a budget of 504. Let's see up by how much. Up by it is 5.55%. So basically, the answer is D. But it's a good question, okay, students? Basically, question says originally we had a market share 18%. So 5,04,000 units, they represent 18% of the market. So it means 100% for finding out the market size 100%. We just did one thing. We gross up 5,04,000 units from 18%. We brought them to at 100%. So the market size is 2.8 million units. Then examiner says the market size has reduced by 5%. What I did, we took 95% of 2.8 million, which is 2.66. And now in this market, in the market size, now the market size 2.66 million. In this 2.66 million, we have the market share 20%. So I took 20% of 2.66. So actual sales units are 5,32,000. When we compare 5,32,000 with 5,04,000, it gives us up, it has up by 5.55%. So I'm considering this as one of the good questions, I would say. One of the best questions. Okay, let's go ahead. Now question 190, students, kindly attempt this. Again, I'm giving you 2 minutes to do it. Sales market size variance. Student, if you recall that technically sales market size variance is a planning variance. Of course, we don't investigate every time every planning variance, but it does not mean that we will never be investigating the planning variances. We still investigate in order to at least get the learning. So sales market size variance is the planning variance, and in planning variance actually is a difference of two things. One is your original budget, and another is a revised budget. Let's see. According to everything is same. According to the original budget, original budgeted sales units is 5,04,000. Now, the new market size after decline of 5% is, we have calculated, it is 2.660, million. So according to the standard, now I should be having 18% of new market size. So the revised budgeted units, great, revised budgeted sales units, 4,78,800. Of course, the variance is going to be adverse because there's a decline in the market size. Revised is 4,88,000, 4,78,800 minus 5,04,000. Into standard contribution is 12. So market size has reduced, so definitely the variance is adverse. Student, everyone was getting a correct answer. 3,02,400. So simply I would say perfect. There shouldn't be any issue at all. Just a minute. Okay, or you can do this as well. Original market size was 2.8 million. It has reduced by 5%. So the dip in the entire market is 1,40,000. Dip in the entire market is 140. Obviously, we don't have 100% share of the market. We have 18% share of the market. Entire 1,40,000 is not a loss for us. The loss for my company is 18%, whatever the entire dip has come in the market. If I take 18% of 140, I'm getting 25,200. Multiply by the contribution. You can see that we are getting the same result. Adverse. Why adverse? Because the market size has reduced. So obviously the variance is going to be adverse. So I hope it is clear to everyone. It's up to you, whichever method you are following it. Question 191. What is the market share variance? Student, if you recall, market share variance, technically it's an operational variance. It is controllable. So I want everyone to 191. And you have got around 2 minutes. Let's see who is going to reply. A company manufactures specific clinical machine used in hospitals. The company holds a 2% share of the market. How much? 2%. And the total market demand has been constant, which is 2,50,000. Machine for the last few years. The budgeted selling price of each machine is $10,000. and a standard contribution is equivalent to 10% of the budgeted selling price. It means if I take 10% of 10,000, so the standard contribution is 1,000 per unit. An initial performance review of the company, actual results showed a sale volume 5,600 machine has been achieved. The total market demand for the machine although had risen to 3 lakh, and we have got share in the market how much? 2%. If I take 2%, now market size is not 250, it is actually 3 lakh. If I take 2% of this, logically I should have sold how many units? 6,000. But we have actually sold less than that. We should have sold. Now basically your budget has revised. The market share remains same, which is 2%, but according to that 2%, we should have sold, in order to maintain that 2%, we should have sold 6,000. The revised sales volume should have been 6,000 rather than 5,600. So logically, we should have sold 5,000, we should have sold 6,000 units, but actually we are selling less than that. So actual sales units are less. Revised sales budgeted units, they are more. So variance is going to be adverse. So 5,600 your actual sales units, I will compare this with the revised budgeted units, which are 6,000 into 1,000. So we are getting 4 lakh adverse. Kindly check, student, yes or no. Please, everyone check this. Now, please try 192 material operational price variance. Try this. Okay, let's see the answer by the student. Okay, great. Everyone is getting the same result. What is the materials operational price variance? Simply material price variance. If you recall material price variance, if your actual material price is higher than the standard price, then variance will be adverse. In case of material, if your actual price is higher than standard price, then variance is going to be adverse. Otherwise, vice versa. And how do we actually calculate material price variance? We need actual quantity, we need actual price, we need a standard price. Let's see. PBS company uses recycled plastic to manufacture shopping baskets for local retailers. The standard price of the recycled plastic is 0.5 per kg. Recycled plastic is 0.5 per kg. And a standard usage of recycled plastic is 0.2 kg for each basket. Okay. The budgeted production was 80,000 baskets. Due to recent government incentives to encourage recycling, the standard price of recycled price was expected to reduce to what? 0.40. So now logically now we'll be using 0.40. Revised standard price per kg. The actual price paid by the company was 0.42. So it can be seen that actually you are paying more than the revised budget. So the variance will be adverse. Per kg, 1 lakh baskets were manufactured using 20,000 kgs of recycled plastic. Okay. Material price variance is equal to actual quantity is 20,000 kgs for the recycled plastic. Revised standard price for recycled plastic per kg is 0.40. We bought it actually for 0.42. So the revised standard price is lower. Actual price is more than that. So obviously the variance will be adverse. Let's see how much AdWords we are getting. Students, I'm getting 400 AdWords. Kindly check. I'm getting 400 AdWords. Okay, now kindly try to attempt question 193. I'm giving you around 5 minutes. Let's see who will reply today. Okay, let's try now. After adjusting for the external factors outside the manager's control, in which category or categories is are there evidence of, we need to find out which category is actually showing the poor performance. A profit center manager. If you are a manager of a profit center, it means there will be two things will be happening in your particular profit center. One, in profit center, what happens? Cost will be incurred as well as sale will be generated. Profit center manager claims that poor performance of her division is entirely due to factors outside her control. Okay. She has submitted the following table along with the notes from a market expert, which she believes explain the cause of poor performance. Look at this market expert notes. The entire market has decreased by 25% compared to the last year. The product will be obsolete in 4 years' time. The entire market has decreased by what? 25% compared to last year. So no issue at all. If you look at this, last year you sold 400 units. You are saying market has reduced by 25%. Okay. And your actual sales units are 300 and budgeted are 500. Of course, logically, I cannot compare actual sales units 300 performance against the 500 units. Makes no sense at all, especially when the market has decreased. So we can flex our budget. I can bring my entire budget from 500 units to 300 units, no issue at all. Of course, when I'm going to bring my 500 budget, I'll flex this to actual activity. Then obviously this is not resulting, it will not show your poor performance. Okay. Another way is entire market has decreased by 25% compared to the last year product will be. So it means if I take last year 400 units and it has reduced by 25%, so if I take 75% of this, I'll get 300 units. So my manager is saying previously whatever was the sale, it has reduced by 25%. No issue at all. I can just flex my budget to your actual activity. So even if I take this 75% of 400, I'll be having a flex budget at 300 units. So basically, the first sale volume is not representing your poor performance. Okay. Sales revenue. Look at this. 50,000 divided by 500, the selling price is 100. 28,500 divided by 300. 28,500 divided by 300 gives me the selling price 95. Last year it was again 100. Rivalry in the market, so selling price fall by what? 10%. If I take my 100 and I reduce this selling price by 10%, so I should be taking 90% of that, it is 90. Now listen, even I reduce my original standard selling price by 10%, I'll get 90. And actually I am selling at 95. So this is not again showing my poor performance. It shows actually a good performance. That even I reduce my price, it will come to 90, but we have managed it to sell it for 95. So sale revenue is also not representing poor performance. Material cost 10,000 divided by 500. $10,000 divided by 500, I'm getting 20. 6,500 divided by 300 units, I'm getting 21.67. Previously, oh, there's no need. As demand for the raw material is decreasing, supplier lowered their prices by what? 5%. Now, this is something very interesting. Already, we are we are paying more than the original standard material cost. And the question says, the external market experts, as demand for the raw material is decreasing, supplier was charging 5% less. According to that, if I reduce my standard purchase price of the material by 5%, so if I take 95% of 20, it should be 19. So the material which I should be buying should be costing me $19 for 1 unit. We are actually paying 21.67 despite the fact that suppliers, they have reduced the price for the material. Even the suppliers, they have reduced the price for the material by 5%, but still we have managed to buy it expensive. That actually shows poor performance. So material cost only. So material cost only actually shows the poor performance. Is that clear, students? Let's go for the last question. Which of the following statements are true regarding planning and operational variance? Okay. Planning and operational variances are calculated when it is necessary to assess manager on results that are within her control. Makes sense. Planning and operational variances are calculated when it is, of course, when do we calculate especially planning variance? When it is necessary. Then we calculate operational variances to assess manager on the result that are within his or her control. Planning and operational variances are calculated when it is necessary. That makes sense. Okay. Revised standards are required because variances may arise partly due to an unrealistic budget and not solely due to operational factors. Again, that makes sense because they are talking about planning and operational variances. Revised standards are required because variances may arise partly due to what? Unrealistic budgets. There's a possibility that variances are coming because of unrealistic budgets. So we need revised budgets, revised standards. If we are not having revised standards, then obviously there's no benefit of assessing the performance against unrealistic budgets. So both the statements are true. So students, I took the class yesterday as well, and today we have completed all the MCQs of standard costing. I think admin has also shared the complete details of pre-scene mock. If not, then I think today they will reveal the date and everything. First, you people should be attempting the ACCA pre-scene mock, and then in a live class, we are going to discuss ACCA pre-scene mock. And again, I'm telling you, in the entire PM, if there is any topic which you want me to revise, so I can arrange the live class. In that live class, we can have a revision of that topic. So, but you need to do it ASAP basis, because once we will start the discussion of pre-scene mock, then it becomes difficult to take out the time. So my offer is still there. Any area in the entire syllabus which is disturbing you, if you want me to have a revision class, so I can conduct revision classes on that topic. So thank you very much. Hope to see you all and others in the coming live revision classes as well. Thank you.